Hello and welcome back to another episode. Today's topic is earned income. How is my income taxed? And this is our second podcast episode that we're doing in our How is my income taxed little mini series. And understanding how different types of income are taxed can be confusing, and it's something that we see pop up all the time in our free Facebook group and tax minimization program. So if you haven't joined our free Facebook group, join now. Go into Facebook, type in Small Business Tax Secrets, answer a few questions and join. As well as if you are not a member of our tax minimization program, I highly recommend you join. We have a ton of content around tax strategies, how to implement them, videos, downloads, templates. We have monthly group trainings. You also have unlimited access to our team to send over those general accounting and tax email questions whenever you need some assistance to walk you through this journey. So you can check that out at taxsavingspodcast.com/tax. Now, if you haven't checked out our first podcast episode last week on what is ordinary income tax versus capital gain tax, you're going to want to check that out because it also plays into a lot of what we're talking about today. Now, the three main types of income that we want to focus on is earned income, passive income, and portfolio income. Today, we're going to be focused on earned income. So let's start very basic. What is earned income? Now, per the IRS, earned income includes all the taxable income and wages you get from working for someone else, yourself, or from your business or a farm you own. So basically, earned income is a direct result of the work or service you do, or in other words, income from your day job. This is typically income from activities that you're actively participating in. With this type of income, you are either an employee or self-employed. So typically you're going to see this in the form of wages, which would be a form W-2 if you're an employee of someone, or small business income, including contractor and gig work. This stuff is normally coming from a form 1099, and you're going to report those types of income on your Schedule C. So examples of earned income include wages and salaries, tips, commissions, business income minus the expenses that you have related to it, gig work, freelance work, and things like that. Earned income does not include interest and dividends, pensions and annuities, Social Security, child support, unemployment benefits, and alimony. So now that we kind of know what earned income is, this is going to be what your day job is, that W-2 work, that business, small business that you maybe own. How is earned income taxed? And the unfortunate part about earned income is that it is often subject to the highest taxes when compared to other income types. So there's a couple ways actually that earned income is taxed. It's taxed multiple times. The first one is FICA taxes, and this is if you're an employee of someone. This is going to be Social Security. So you're going to be taxed Social Security tax, which is 6.2% on up to $147,000 for 2022 of your W-2 income. Now, your employer also covers the same amount for you. Now, also part of FICA is Medicare, and this is 1.45%. And you're going to also add 0.9% if your income's over $200,000 if you're single, or $250,000 if you're married. And your employer also covers this same amount for you, this Medicare tax. So your W-2 income, if you're an employee of someone, is going to get hit with Social Security tax, 6.2% up to $147,000 in 2022, and Medicare tax, 1.45%. Now, if you're self-employed, so think of those of you that are sole proprietorships, single member LLCs, partnerships, you're going to be paying self-employment taxes. And this is, again, broken down into Social Security and Medicare, but now you are the employer. So you're paying for both the employee portion and the employer portion. So Social Security, their self-employment taxes are 15.3%. And this is broken up by 12% based on Social Security. That's up to $159,000 roughly for 2022. And then Medicare, that's going to be 2.9%. Again, you're going to add another 0.9% if you're over $200,000 if you're single. So earned income gets hit with FICA taxes if you're an employee, or self-employment taxes if you're a sole prop single member LLC. Your income also gets hit with your ordinary income tax rates. So this is just your normal income tax rates using the tax brackets, ranging anywhere from 10% to 37%. And again, if you haven't listened to last week's podcast episode, we talked about the ordinary income tax rates, what those are. So as an example, if you're an employee working for someone else, you would pay both FICA taxes on your income along with your ordinary income tax rates. And if you are self-employed, operating as a sole proprietor, you're going to pay both self-employment taxes on your income along with your ordinary income tax rates as well. Now, many people might be thinking, we talk about S-Corps a lot. How is S-Corporation income taxed? And you'll notice that when we talked about being self-employed above, we did not talk about S-Corporations, just sole props, single-member LLCs, etc. First, as we know with an S-Corporation, you have both payroll, a reasonable salary, and distributions, or dividends. And so payroll, of course, would be considered earned income. On the payroll portion, you as an employee of your own business will pay FICA taxes, and then you as an employer will also match that FICA tax for you as an employee. So essentially, this is equal to self-employment taxes. And you're also going to pay your normal ordinary income tax rate on your salary. Now, here's where things get a little funky. The income from your S corporation, this is going to come through via K1, it's going to pass through to you, that you report on your personal return is technically not considered earned income, but rather non-passive income. So this is, of course, assuming you actively participate in an S corporation. Now, here are the benefits of the S corporation. FICA taxes, aka self-employment taxes, stop at your salary, and the remaining income from the S corporation is simply taxed to your ordinary income tax rates, and you avoid self-employment taxes on it. So when we talk about an S corporation, this is oftentimes why we talk about the benefits of it. So your salary portion is going to get hit with FICA taxes and aka self-employment taxes, as well as your ordinary income tax rate. And then any other income from your S corporation is just going to be hit with your ordinary income tax rate. No self-employment taxes, no FICA. If you want to learn more about an S corporation, we have a ton of information on them. A link in the show notes will take you to there. We did an episode a couple weeks ago. What is an S corporation? When should I or should I not become an S corporation? And then last year, we also did an entire series called Everything You Need to Know About S corporations. So check out those if you're interested in that. Now, let's talk about what is the good thing about self-employment income or even non-passive S corporation income. And you might be thinking, why would I ever want to have earned income if it's taxed at some of the highest rates? And that's truly a valid question. In a perfect world, we would not have any earned income. But ultimately, unless you landed in an extremely wealthy family, you have to create your own wealth somehow. You have to create your income somehow, and that will almost always start with earned income. So if you're starting from nothing or little money, you have to earn it somehow. And this is often why we say earned income should be used to build wealth. But once you have that wealth, once you have that money, you should look to shift income into passive and portfolio income to help minimize your tax hit. And we're going to be talking about both of those in the coming weeks. With that being said, the good thing about both self-employment and S-Corp income is that you can utilize the tax code to take deductions or write-offs to help offset your income. So if you're set up as an S-Corporation, or let's say you're set up as a sole proprietorship, and you make $100,000 in sales, you have expenses that you can offset at least a portion of that income with. So think of things, you can offset your business income with allowed business expenses. So think of things like maximizing deductions, taking advantage of meals, automobiles, travel, etc., hiring your kids in your business, utilizing retirement accounts, taking advantage of depreciation, and so much more. So we talk about a lot of these tax strategies that you can utilize as a business owner. That's what we're talking about. We talk about them in our Small Business Tax Savings podcast here. We also dive even deeper into them on our tax minimization program. So let's go through a summary of kind of earned income. Ordinary income tax is just your typical marginal tax rates. We talked about that in last week's episode. Earned income is subject to both FICA taxes if you're an employee or self-employment taxes if you're self-employed, plus ordinary income tax rates. So earned income, if you're an employee, you're going to pay FICA taxes, plus, or earned income, if you're an employee, you're going to pay FICA taxes, plus your ordinary income tax rates. If you're self-employed, you're going to pay self-employment taxes plus your ordinary income tax rates. Utilizing an S corporation is a potentially great strategy for the self-employed to minimize the amount of self-employment taxes they get hit with. Ordinary income or earned income cannot be offset by passive losses. So if you're unsure what passive means, we're going to be talking about that next week. Earned income is oftentimes the highest taxed income you will experience. And the great thing about self-employment and S-Corp income is that you can utilize the tax code in your favor to take advantage of every possible business deduction available. As always, if you're looking on ways to lower your taxes, obviously check out the episodes we've done here. Look at the various different things that we talk about on our podcast here. That's where we're going to help lower your business income. But if you want to dig deeper, you're saying, okay, I'm paying too much self-employment tax, or I'm paying too much ordinary income tax rates. How can I lower that? Be sure to check out our episodes, check out our tax minimization program. Within our program, we deep dive into strategies. We have implementation guides, downloads, templates, things like that. We do monthly group trainings. And again, you have unlimited access to our team for those general tax and accounting questions. Just email them over. Can I deduct this? How do I do this? Those types of questions. We're here to help support you along this journey. So hopefully this was helpful. Again, if you have not checked out our episode last week on what is ordinary income tax versus capital gain tax, check that out. As a reminder, earned income is just going to be your typical W-2 income, as if you're an employee, as well as self-employment income, and you pay FICA taxes or self-employment taxes on that, as well as your ordinary income tax rate. So I want to thank you for listening to another episode. As a reminder, we're coming up on our Small Business Tax Savings Summit. It's only a couple weeks away, June 14th and 15th. It's a 2-day virtual event. We're going to be running through tons and tons of tax strategies. I highly encourage you to check that out, whether you're just getting started in business or you've been in business for a while. You're going to walk away rejuvenated with ideas from that summit. You can join at www.taxsavingspodcast.com/tax or /summit, as well as our tax minimization program. You can join at taxsavingspodcast.com/tax. Thanks again for listening to another episode. I will see you next week when we talk about passive income and how that is taxed.